So you've got a mortgage renewal coming up, or you just want to understand a little bit more about the topic and the process, or you're just here to see where the rates are heading in 2026. If that sounds like you, then perfect, because this video will be answering all of your questions. For most people, renewing a mortgage feels dreadful, right? It's confusing, it's stressful, and it's usually just another thing on the to-do list that you just didn't want to deal with. I get it, but you need to understand that making an uninformed decision on what is likely your biggest debt, a decision that will lock you in for the next 3, maybe 5 years, is one of the worst financial mistakes that you could make. And I've seen it way too many times. Client comes in, just wants to get it over with, locks into a 5-year fix without really much thought. Look, renewing your mortgage can impact your finances just as much as getting a raise or getting a demotion would. So let's break it all down in this video, so that way, come your next renewal, you're gonna feel a lot more confident, a lot more prepared. What mortgage renewal actually is. Renewal is not a brand new mortgage. It's simply extending your existing mortgage for another term. So real quick, let's define 2 key terms. Amortization. That's the total length of your mortgage, which is usually 25 years, sometimes 30 years, and your term, which is the contract period. This is usually between 1 to 5 years. That's your rate and payment agreement. When your term ends, your amortization continues, but now you need a new term and a new rate. That's the renewal. At renewal, your bank does not re-verify your income or spending unless you were flagged for some reason. See, that feels convenient, but it can be dangerous because convenience makes people lazy, and laziness is profitable, well, for the bank. Renewal decisions are different from buying decisions. Maybe you chose a specific rate when you were buying just to qualify. At renewal, it's different. Your life stage matters. Your risk tolerance matters. What your friend chose is irrelevant. You need to consider the following, and don't worry, I'll break them down further a little later on in this video. Number 1 is inflation trends, or CPI reports. Number 2 is Bank of Canada rate announcements. And number 3 is political and economic forecasts. Context matters. So now let's talk about the different options available. That is fixed versus variable and open versus closed. So in a fixed rate mortgage, your rate and payment will stay the same. It's really that simple. This is best for predictability, tight budgets, and peace of mind. Now, on the other hand, variable rates will follow the prime lending rate. When inflation rises, the Bank of Canada raises rates to slow spending. And when inflation falls, they lower the rates to stimulate spending once more. Once again, we'll look at this more in depth in the next section. With most variable mortgages, your rate will change, but your payment does not. Instead, what happens is you've either got more or less money going towards interest instead of the principal. And if rates rise significantly and you're not updating your payments, then this could quietly extend your amortization. Now, if your payment no longer covers the interest portion, that's your trigger point. The bank will contact you very, very quickly. Now, here's a very powerful feature that most people don't know about. If you have a variable mortgage term, most banks will allow you to convert to a fixed rate during your term, but you must choose a term that is either equal to or greater than the time remaining on your current term. Usually penalty free, but you can expect them to add about 0.1% to the fixed rate that you chose. It's basically your penalty for doing it, but it's stretched out over time, but it usually results in bigger savings than just riding out the wave when you're on variable and the rates are increasing. This gives you a lot of flexibility rather than just locking in 5-year fix at the wrong time. Now let's cover open versus closed mortgages. An open mortgage just means that there's no term, there's no penalty to pay off, transfer, or sell, and because it's not locked in, you're going to get a higher interest rate. So this is only really good for short-term situations. Now, in a closed mortgage, which is the most common, it just means that you're selecting a term and that mortgage will be there for the duration of your term. So you'll have access to better rates because you're locked in, and penalties apply if broken early. Now, for many lenders, the penalty is up to 3 months of interest unless special clauses apply. So now let's talk about where the rate's going in 2026. Before answering that question, we first need to understand how inflation reacts to interest rates. In the late 60s and early 70s, economists recognized how powerful interest rates are in controlling inflation. So in the mid 70s through the mid 80s, inflation spiked dramatically. The Bank of Canada raised prime above 10% and eventually to 22.75% in order to flatten inflation. It was devastating for borrowers, but it proved something very important. The Bank of Canada uses CPI data to guide its decisions, and it works. The strategy became clear: keep interest rates above inflation. And this was the case up until the pandemic. Inflation jumped again. And what was the response? Rate hikes. Did it cool down inflation? Yes. Since the aggressive hikes in 2023, inflation has steadily declined. In 2025, inflation held relatively steady. Because of that, the Bank of Canada reduced its policy rate from 3% to 2.25% and then held it there up until the end of the year as inflation began creeping up again. The CPI average for 2024 was 2.4%, and for 2025, it was at 2.1%. Overall, that's a positive sign. it keeps going down. However, December 2025 CPI reached 2.4%, while the policy rate sits at 2.25%. That is important because once inflation exceeds the policy rate, that's your first warning sign. It should be clear by now that a lot of what happens next is going to depend on the next CPI report, which actually just came out today as of when I'm recording this, February 17. So quick recap, December 2025 CPI was at 2.4%, January 2026 CPI is at 2.3%, and the current Bank of Canada policy rate is at 2.25%. Now, the good news is that inflation is coming down slightly from 2.4 to 2.3%, so this isn't panic territory yet, but it is a warning. Now, to understand what's really driving the number, stats can break CPI into major components so that we can see the trends underneath, and when you compare December to January, almost everything is either holding steady or dropping, except for two major categories that are still rising fast: food and alcohol, tobacco, and cannabis products. And now the government's solution to the rising grocery prices is to give more money to lower income households through the Canada Groceries and Essentials benefit. Now, this is something that the previous government has already tried and quietly walked back after realizing that it didn't solve the problem. Because putting more money into the system does not lower prices. This is a known fact. It raises demand. It creates more shortages and it pushes prices even higher. So now the next Bank of Canada rate announcement is scheduled for March 18, 2026. Keep in mind their target inflation rate is 2%. We've been at 2.4 for December and 2.3 for January, while the policy rate is at 2.25. So as of right now, one thing is clear, the rates are not coming down. But the real question is, do they go up? I mean, personally, I wouldn't be shocked if the rates go up another 0.25% just to maintain control. But based on how the pandemic was handled, I honestly don't think they're going to move the rates at all in March. What matters most is watching the trend, not just the headline number, because by the time that your bank calls you, the damage is already done. So keep your eye on this before they move. So now let's talk about what your bank wants you to do. A few weeks before your renewal comes up, they're going to send you a letter, either online or by mail. It's usually pretty early, and that's because they want to keep your business before you start shopping around. Just know that the first offer they send your way is rarely their best rate. The banks understand human psychology very well. If you do nothing, you are silently accepting. You sign, they keep your mortgage, they profit, and they avoid competition. And your loyalty, I'm sorry, but it's not rewarded in modern banking. Years ago, loyalty meant a lot more, and human connections meant a lot more. But nowadays, when you walk into the bank, what happens? You are directed to the ATM or the website or the app, right? But for the big portfolios, right, the multiple millions of dollars, then it's different. But for the average mortgage holder, sorry, but the reality is you're just another file in their system. So if you walk into renewal and your only argument is about your loyalty, you have very little leverage. And if you don't believe me, then go see for yourself, right? Ask your bank for renewal rates, tell them how long you've been with them, and ask if they can do better and see what they say. Then go and compare those rates to a bank that didn't even know you existed until this very moment. That difference will tell you how much your loyalty is worth to your current lender. Now let's talk about what to do before renewal. Preparation is your leverage. Banks will allow you to renew up to 4 months in advance as long as you stay with them. So start 6 months in advance. Ask your bank for rates. Ask other banks. Consider even going with a mortgage broker. Now, keep in mind that switching lenders may require requalification, but don't worry because rate shopping does not destroy your credit. Credit bureaus understand that multiple mortgage inquiries within 14 to 45 days are rate shopping and not debt accumulation. So they're usually treated as a single inquiry. So if you find a better rate, then make sure you show your current lender and bring proof. I'm not just talking about some ratehub.ca screenshot. If you're a reliable client, meaning that you pay everything on time, they will likely match that rate. They want your money, they want your business. And also, if you're not doing this already, then you need to start following the CPI reports and the Bank of Canada meetings and rate announcements. Do not wait until renewal day to start paying attention. So, should you switch lenders? Well, the answer is, it depends. Switching will make sense when the rate difference is significant, the terms are better, or flexibility improves, but switching definitely does not make sense if the difference is minor, you're selling soon, or the transfer costs just outweigh the savings. Now, here's something very important to understand. When you are transferring your mortgage to a different lender, it is no longer a renewal. It is considered a refinance, even if you're not taking out new money. The new lender must register a new mortgage, therefore the process starts from scratch. scratch. The new lender will have to approve you and send documentation either to a lawyer or a title insurance company. So in Ontario, for example, a lawyer costs roughly $1,000 for a simple refinance, whereas title insurance like FCT is roughly $600. Now keep in mind that name changes, whether that's a marriage or taking somebody off of title, they must go through a lawyer. If you're going through a lawyer, they will take care of discharging and registering the new mortgage. And with title insurance, then the responsibility of discharging and registering the new mortgage basically just falls onto the bank or their representatives. So if you're planning on transferring your mortgage out at renewal and you were also thinking about doing a loan consolidation in order to save on interest, then this is the time to do it. Also, if you're transferring at renewal, it's important to note that most banks will actually cover these transfer costs, such as legal fees and appraisal costs if required, but they do not cover the mortgage penalties from the other lender if you break your term early. Your new lender might also offer these fancy promos for transferring, but be careful because they all come with a fine print. They offer these benefits as long as you stay. So if you decide to leave afterwards, then they may charge you for those benefits. So make sure that you understand the terms. Now let's cover some of the biggest mistakes that Canadians make at the renewal. Mistake number one is automatically renewing with their current lender. You may be overpaying without ever knowing it, and it's completely free to go check, so just go check. Mistake number two is only comparing the interest rate. Like, the terms and penalties matter just as much as the rate, so make sure you understand what you're signing. Mistake number three is waiting until the last minute. If you wait until the last week, you are limiting your time to shop and negotiate. Less time equals less leverage. Mistake number four is defaulting to the 5-year fixed rate. So yeah, it's the most common, doesn't mean it's always good. You need to understand how long 5 years really is. It is a long time. So if the rates are low, then yeah, go for it by all means. But if the rates are at a 20-year high like they were back in 2023, then that decision will age like milk. Mistake number five is renewing solely based on your next move when upsizing. Although it might seem like a good idea, but renewing at a shorter term can actually cost you a lot more than you think. Shorter terms tend to be higher rates since the mortgage is locked for a shorter period of time. Guys, when you move, the balance of your current mortgage will transfer to the next property as long as you stay with the same lender. It'll transfer completely penalty free. And if you're upsizing, then you're likely increasing the mortgage amount. That new mortgage amount will be added at the current market rates. And that together will create a blended rate, which is weighted between your old and your new rate. I hope this video helped you better prepare for an upcoming renewal or just helped you understand the process overall. If it did, please be sure to hit the like and subscribe buttons. It's truly the best way to return the favor. I would really appreciate it. But also that way you're going to see more Canadian real estate and finance related videos such as this one, which may be right up your alley. So with that being said, thanks for watching. Until next time.